I need you to stop what you're doing and look at the screen. That massive red candle you see on the silver chart isn't a market correction, it is a crime scene. At exactly 4 a.m., while the retail investor was asleep, institutional volume spiked 400% in a single minute. This wasn't a panic sell-off, this was a calculated execution. It was a stop-loss hunt designed to steal your position mere hours before the real move begins. We are going to dissect the trade logs and prove exactly who pulled the trigger. Let's analyze the anatomy of this 4 a.m. slam. You have to look at the specific timing. 4 to Wuzlar a.m. New York time. This is the witching hour between the Asian close and the London Open. Liquidity is at its absolute thinnest. If you are a bullion bank looking to crash the price with minimal capital, this is the kill zone. You don't dump $1 billion of paper silver at noon when the whole world is watching. You do it in the dark, you wait until the order book is empty, and then you strike. This is a classic stop hunt. Here is the mechanic. The banks have access to data you do not. They see the level 3 order book. They know exactly where the retail stop-loss orders are clustered. By dumping massive amounts of futures contracts in a split second, they force the price down just enough to trigger those automatic sells. When your stop hits, you become a market seller. You're forced to sell at the bottom. And guess who's on the other side? The same entity that pushed the price down. They are harvesting your fear. Now, look at the dollar index. Normally, silver and the dollar are inversely correlated. If the dollar spikes, silver drops. That is the algorithm. But look at the chart during the crash. The dollar was flat. It was dead water. Silver plunged 3% while the dollar did nothing. That disconnect is the smoking gun. It proves this move was not driven by macroeconomics. It was driven by a deliberate manual override of the price discovery mechanism. Let's talk about the volume anomaly. In that 10-minute window, the notional value of paper silver traded exceeded $3 billion. Do the math. That is more silver than every mine on the planet produces in a month, traded in 10 minutes. It is physically impossible. This is not metal moving from one vault to another. This is digital confetti. They are printing infinite paper supply to suppress the price of a finite physical asset. Why do this now? It is psychological warfare. They know the physical shortage is undeniable. They know the vaults are draining, but they need you to doubt yourself. They need you to look at that red candle and feel that knot in your stomach. They want you to think, maybe I was wrong. If they can get you to capitulate now, they can close their short positions before the explosion. And finally, look at the recovery. See that sharp V shape? The price ripped right back up the moment the selling stopped. That is the hallmark of a manipulation event. A real market crash stays down. A manufactured crash snaps back the moment the predator has filled his belly. The price is back to where it started, but your position is gone. They shook the tree and you fell out. But now that we see how they did it, we need to look at why. And the answer lies in China. Now that we see how they did it, we need to look at why. And the answer lies in China. Connect the dots. While the price of silver was collapsing on the COMEX in New York, do you know what was happening on the Shanghai Gold Exchange? The price was trading at a massive premium. We are talking about a spread that reached nearly 12%. This is the arbitrage signal that screams the system is broken. You have paper silver in the West trading at a discount, while physical silver in the East is trading at a premium. This is what we call backwardation in the physical market, and it is the single most important indicator that a delivery crisis is imminent. In a normal, healthy market, the future price is higher than the spot price to account for storage and interest. That is called contango. But right now, we are seeing the opposite. The spot price for immediate delivery in Shanghai is ripping higher because nobody wants a promise. They want the metal, they want it in their hand, and they want it now. This backwardation proves that the paper price in New York is a lie. It implies that the physical market is so tight, traders are willing to pay a massive penalty just to secure the bar today, rather than wait for a contract next month. Think about the mechanics of this operation. If you are a Western Bullion Bank and you know the physical inventory is running dry, what do? You cannot buy metal at the true market price because that would send the chart vertical. So you use the paper market to smash the spot price in New York, you create a panic, you trigger the stop losses we just talked about, and then, while the price is artificially suppressed, you quietly buy physical bars off the market to ship east. They are slamming the paper price to cover their shorts, while simultaneously buying physical metal to satisfy the insatiable demand from Shanghai. This $17 billion paper dump is not a market correction. It is a tourniquet. It is a desperate attempt to stop the bleeding of physical inventory before the patient dies on the table. The Western banks are trying to cauterize the wound, but the blood loss is catastrophic. Look at the import numbers coming out of India and China. These are not estimates. These are customs receipts. India alone is importing silver at a pace that mathematically exhausts the entire global supply in 8 months. They are not buying paper contracts. They are taking delivery of 1,000-ounce bars. They are backing up the truck while the price is cheap. And here is the irony that nobody in the mainstream media understands. When the COMEX smashes the price, they are actually subsidizing the Chinese accumulation. They are putting silver on sale for the very entity that is draining the vault. It is a transfer of wealth from the impatient Western paper trader to the patient Eastern physical buyer. Every time they smash the price, the East says, "Thank you," it takes another 1,000 tons off the market. The lower the price goes, the faster the physical metal disappears. It is a feedback loop of doom for the short sellers. The East is buying real metal, but the Western banks are drowning in paper leverage. But this brings us to the real reason volatility is exploding. We have to look at the Commitment of Traders report. This is the COT data that the regulators publish every Friday. It is the crime sheet. When you peel back the layers, you see a massive concentrated net short position held by the commercials. Now, do not let the name fool you. These are not commercial companies like Samsung or Tesla hedging their inventory. These are the bullion banks. These are the market makers. And right now, they are sitting on a leverage bomb that is ticking louder than ever before. You need to understand the paper to silver ratio. This represents the number of paper ounces traded on the exchange versus the actual physical ounces available for delivery in the registered vaults. Right now, that ratio is astronomical. For every single ounce of physical silver sitting in a vault, there are hundreds of paper claims floating around the COMEX. It is a game of musical chairs, where there are 500 people circling one chair. As long as the music plays, everyone feels rich. But the moment the music stops, the moment people stand for delivery, the illusion collapses. Now, look at the open interest. This is where the manipulation becomes mathematically undeniable. In a normal market, when the price crashes, open interest should drop. That means traders are liquidating. They are taking their losses and going home. But look at the data from the 4 a.m. slam. The price dropped, but open interest spiked. Do the math. That means new money was entering the market to force the price down. They were not selling because they wanted to get out. They were selling to open new short positions at the bottom. This is aggressive, naked, predatory shorting designed to cap the price. Why are they doing this? Because they are trapped. The bullion banks are shorting silver at $28, $29. If the price breaks through the $32 resistance level, it triggers a margin call that would wipe out their quarterly earnings in a single afternoon. They are defending this line with their lives. They must crash the price to survive. If silver goes to 50, these banks are insolvent. It is mathematically that simple. They are not trading for profit anymore. They are trading for survival. We saw exactly what happens when this goes wrong during the nickel squeeze on the LME. The price went vertical, the shorts got squeezed, and the exchange simply canceled the trades. They effectively changed the rules in the middle of the game to save the banks. Do not think they won't do it again. When the commercials get cornered, they don't pay up. They flip the table. They are engaging in naked shorting, selling metal that does not exist, to suppress the price discovery mechanism, because the alternative is total systemic failure. They are playing a dangerous game of chicken with the physical market. They are betting that they can scare you out of your position before the industrial users drain the vault. But here is the fatal flaw in their strategy. They can print paper contracts until your printer runs out of ink. You can leverage $1 billion of notional value in a millisecond, but you cannot print physical ounces. You cannot print a silver bar. And that physical reality is about to collide with their paper fantasy. We have to shift our focus to the only thing that actually matters, the physical inventory in the vaults. You need to ignore the spot price for a moment and look at the LBMA in London and the COMEX in New York. The data is screaming danger. You have to understand the difference between eligible and registered inventory. This is where they hide the truth. Eligible silver is just metal that meets the purity standards. It is sitting there, but it is not for sale. It belongs to private investors, family offices, or sovereign wealth funds. It is not available to settle a trade. Registered silver is the working inventory. It is the only metal available for delivery against a futures contract. And if you look at the chart for registered silver, it has fallen off a cliff. We are sitting at historic lows. The buffer is gone. The warehouse is effectively empty, but they are still selling receipts for goods they do not have. The leverage on those remaining registered ounces is astronomical. We are watching the bottom of the barrel being scraped in real time. Now look at the industrial floor. This is the demand that does not care about the Federal Reserve. Solar panel production, photovoltaics, is consuming silver faster than the miners can dig it up. We are seeing a technological shift where the new generation of high-efficiency solar cells requires 50% more silver per unit. This is not speculative demand. This is physics. You cannot build the green energy transition without silver. The International Energy Agency knows this. The governments know this. You cannot build a Tomahawk missile without silver. You cannot build an electric vehicle without silver. Silver is the most conductive metal on the periodic table. There is no substitute. These industrial giants are price inelastic. If Apple or Samsung needs silver to build a phone, They will pay $30, $50, or $100. They do not care. They need the physical atoms to make the circuit work. They will drain the COMEX dry to keep their assembly lines moving. We are currently in the 4th consecutive year of a structural supply deficit. The Silver Institute has confirmed this. We are seeing deficits of 200 million ounces a year. We are consuming more metal every single year than we produce. We are eating into above-ground stocks that were mined decades ago. The cushion is gone. And the terrifying part for the banks is that supply is inelastic. This is a geological reality. You cannot just turn a dial and produce more silver. Because of falling ore grades and environmental regulations, it takes 10 years to permit, build, and ramp up a new mine. The miners are struggling just to keep production flat. Even if the price went to triple digits tomorrow, the physical supply would not increase for a decade. We are walking into a hard mathematical wall. This leads us to the unobtainium scenario. This is the nightmare for the shorts. It is the moment when a major industrial user, a defense contractor, or a tech giant, stands for delivery on a massive order to secure their supply chain, and the vault manager says, "We don't have it." That is when the price disconnect resolves instantly. The exchange will declare force majeure, they will settle in cash, and the real physical price will detach completely from the paper price. This price plunge you are watching right now is the final shakeout. It is a desperate attempt to shake the loose hands out of the market before the industrial reality overrides the paper manipulation. Holding unencumbered physical metal is the only hedge against this inevitable implosion. So here is the reality. The price drop is fake, the physical shortage is real. That red candle is a weapon designed to steal your position. Do not let a paper derivative shake you out of a physical asset. We track the vault data every single day. If you want to see the numbers the banks are hiding, hit that subscribe button right now. Watch the premiums, not the spot price. The math doesn't lie, and the vault is empty.